This interview is sponsored by Grantstone Shoes. Grantstone Shoes is a third-generation family of shoemakers that uses high-quality leather to make very high-quality men's dress shoes and boots at affordable prices. Mo and I each have a pair of these shoes. We think they're good. We've been wearing them for over a month now, trying them out. If you don't believe us, go check out the customer reviews for Grantstone Shoes. They have a lot of 5-star customer reviews. They also have excellent reviews from independent fashion bloggers. And if you like the shoes, enter promo code GOLD, that's GOLD, on the grantstoneshoes.com website for 10% off your order. That's grantstoneshoes.com, enter promo code GOLD for a 10% off discount. Hi everyone, it's Jason Barrack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has over 20 years of experience working in different jobs in the oil and energy sector. He also writes energy investment newsletters. Robert Rapier, thank you for joining me again.
Thanks for having me on, Jason.
You're welcome. I always enjoy your opinions, Robert, about the oil and energy markets. We haven't had you on in a while. The oil market has been very volatile this year, both going up and down. I want to talk about your article first, though, from August. You wrote an article about generating free cash flow in the oil industry, companies that generate over $1 billion. I'll put a link for our listeners to look at the article later. Do you think the oil companies in general have done a good job cutting costs and figuring out how to generate free cash flow in this environment?
A lot of them have, not all of them for sure. I mean, if you scan through, you'll see plenty that are either bankrupt or on their way to bankruptcy, and you'll see some that have learned to live within their means. And that's always the case. The oil industry is cyclical, and during the good times, you'll always have producers that go out there and over leverage themselves. And as long as oil prices are going up, they do very well. But as soon as oil prices turn, they're in trouble. And those are the guys that went first. And then, the longer oil prices stay, in this range, the more people are going to go bankrupt. But, you have the EOG resources of the world that are, learning to live with this, with $50 oil. And they can generate cash flow at this level. The problem is when oil prices are going up, people are spending a lot of money on capital that takes years, projects that take years to complete. So you will often see really negative cash flow for the first, couple of years of a downturn before people start cutting back on their capital expenditures. ConocoPhillips is another. They just released earnings, and 2 years ago or 3 years ago, they were spending something like $4 billion a quarter in capital. And this last quarter, they were under $1 billion. So, they've drastically cut. You just can't justify the sort of capital at these oil prices that you could when oil was at $100.
Is ConocoPhillips generating free cash flow, or are they kind of just treading water like a lot of the oil industry right now?
Well, ConocoPhillips was bleeding pretty heavily. They are treading water right now. They're about cash flow neutral. They generated enough to fund the capital expenditures and the dividend in this last quarter, where that hadn't happened since the oil downturn happened. They had to slash their dividend late last year, after telling investors that they wouldn't have to do that. They told people all year they wouldn't have to do it, and then there at the end of the year they said, "Yeah, we got to cut it." So they cut it from, I think it was 75 cents to a quarter. So they really slashed it, and that has hurt them and hurt their credibility. But this last quarter, there's a lot of articles that have come out saying, ConocoPhillips maybe has finally turned a corner. They're one of the only oil companies that are down for the year. If you look, despite the tough oil and gas price market, most oil companies are actually up for the year because investors are looking ahead and saying, yeah, the worst is behind us and we have better times ahead. But ConocoPhillips was, the last time I checked, still down in 2016.
Yeah, I'm looking at the charts here in this article, and it is from August, so obviously the companies are going to be announcing earnings again soon. But I really like how companies like EOG Resources, Anadarko Petroleum, Apache, some of those companies, the oil producers, obviously with the oil service sector companies, those companies don't have as much capital expenditure necessarily as exploration and production oil companies, so it's easier for those guys to generate free cash flow. But the exploration and production companies that are generating free cash flow in an environment like this, I think it's very impressive.
Exactly. And it's important to pay attention to free cash flow because that's less subject to manipulations and accounting tricks. I mean, you can see, how much cash do you actually have to fund your expenditures, and that's a really good metric to pay attention to is free cash flow.
Yeah, I completely agree. Most investors don't look at free cash flow a lot. They tend to, when the oil market's in a boom phase, they tend to just chase it higher on momentum rather than looking at what could happen on the downside if the oil price were to have a correction. Now, I want to transition and ask you about the supply-demand fundamentals of the oil market. We've been hearing about inventories lately, that they're declining in the U.S., but I see the global economy is slowing down. So do you think demand for oil globally, when you add in the U.S., do you think it's still relatively strong?
Yeah, I think the last I saw, the IEA forecast 1.2 million barrels a day of demand growth this year, 1.2 million barrels of growth next year. So, when people say slowing, it is, it grew a lot more than that last year. It was up like 1.7, 1.8 million barrels a day of demand growth last year. But the 30-year average is about 1 million barrels a day. So we're still tracking on that 30-year average. Certainly demand is not declining. And you'll see that sometimes in China. You'll see quarterly demand go down, and then suddenly people say, oh, demand is now falling in China. And then the next quarter it'll pop right back up. So, and you got a lot of other developing countries like India and Vietnam, whose oil consumption is increasing quite rapidly. So yeah, the problem with the oil markets right now are still inventories are quite high, and we are, a lot of production in the U.S. has started to be shut in. You've seen oil production in the U.S. fall by about 1 million barrels a day over the last year. And the U.S. is where most of the demand growth happened. Most of the production growth happened over the last decade. Most of it was in the U.S. And so if a lot of it's going to hinge on OPEC, if OPEC actually can get their act together and make cuts, you'll see us back to $60 pretty quickly. If they don't, and there's news, that they may not be able to, get their act together, I think we'll stay in the $50 range, for maybe another 6 months, and then I think we'll break out from there. We did have a big inventory build this week, and that sort of crushed prices a little bit. It was unexpected. It was very, very high inventory build in the U.S., and I think that spooked markets a little bit.
You bring up an interesting point about OPEC with Vladimir Putin. He seems to want to take over OPEC and reform it into a new type of oil cartel, and he wants to run it now because he thinks they're ineffective. You mentioned also about the track record of OPEC. OPEC just doesn't have a good track record of doing what they say. So I don't think most people, we really shouldn't believe them given their track record of actually doing cuts or abiding by the quotas that they have in place.
Well, they have done it before. In 2005, the markets were calling for more oil, and OPEC sort of just sat on their hands. And that's the main reason oil ran up to $100. They were not investing the money they needed to expand the markets because they said things are fine. And then in this latest crash, OPEC. First of all, the U.S. put about 5 million barrels a day of oil on the market over the course of 6 or 8 years. But then OPEC opened up the floodgates and dumped nearly another 2 million barrels a day on that. So when people say OPEC has no power, say OPEC's the reason, it's a big part of the reason that oil prices fell as far as they did in the first place. Keep in mind, they produce more than 40% of the world's oil. You throw Russia in there, and they're producing over half the world's oil. Those guys together could really do some damage if they could get everybody on the same page. As far as reserves, they've got 70-something% of the world's remaining proved reserves. They could be in a very powerful position, but you've got all these individual countries acting in their own self-interest. And if they ever would say, let's act in the self-interest of OPEC, and yes, we'll all take a little bit of a cut, they could stab oil prices just about wherever they want. Now, Shale would react. The guys who leveraged all that cash, they'd do it again. You'd see oil production head back up in the U.S., but it'd be kind of a game to see, how long can that go on. I don't know how long shale production in the U.S. could expand, but that's OPEC's fear. OPEC's fear is If they prop up prices too high, then they're going to enable shale production in the U.S., and they're going to end up having to just cut production again.
Yeah, you brought up additional supply coming online. What worries me on the supply side, besides how a lot of the shale producers, they keep getting all this capital. I was thinking there was going to be more bankruptcies, and they've been able to cut costs at least somewhat over the years in order to keep producing shale oil. But we have Russia and Saudi Arabia running at max capacity basically for their oil production. We have Iran, Iraq, Libya, and also other parts of the Canadian oil sands that want to increase oil production. So this seems like a big overhang of potential supply that could hit the market. If we get back up to that $60 a barrel range, I don't think it would stay there very long, given how much additional supply wants to come online from those other countries.
Yeah, I mean, I've done the numbers on that before. I think, in 2014, we probably had the price decline began in the summer of 2014, and by November, the prices had fallen to about $75 or $80, and we probably had at that time about 2 million barrels a day of excess capacity. Now, if OPEC had taken off 2 million barrels a day of capacity, the market would have been balanced. Inventories would have still been high, but we would have been balanced. And instead, they threw another almost 2 million barrels a day onto the market, and they exacerbated the problem. And they were trying, they wanted to put the shale guys out of business. There's a lot of speculation. Well, they also wanted to hurt Iran. Saudi wanted to hurt Iran. The main thing was they were afraid of the shale. I mean, there was no sign and slowdown of shale, and they really thought that the marginal production of shale was maybe $60, and they could knock out most of the shale guys below $60. I mean, I'm convinced that's what they believed. And the shale producers were a lot more resilient than what they expected. And, I saw comments afterward, 6 months later when oil prices had fallen so far, there were a lot of people saying, in OPEC, we didn't really foresee this. We didn't see this kind of decline.
Yeah, I think that too. I thought that around $65 a barrel, the shale producers were all going to be in trouble. They weren't really generating any free cash flow when oil was around 100. There was a few like EOG, but a lot of the higher cost producers weren't. They were reinvesting into drilling new wells. That's the thing about shale with the decline curves. So I don't know how the shale guys have been able to survive to this point. I know they've been able to cut costs, but these wells just don't seem that profitable long term to me. I think we're going to have a capex another guest I'm going to have on soon is Rick Roll, and he says he's bearish in the short term on oil and bullish in the long term. So he thinks that we need to have a lower oil price to wipe out those higher cost producers that should have went bankrupt during the $29 oil price when we had it about 8 months ago, late 2015, early 2016. And he thinks once we have those bankruptcies and more marginal supply come offline, then he thinks the market will clear and it'll be very good investing opportunities long term.
Yeah, I mean, and you mentioned something I'd expound upon a little bit, that there's a lot of people who think that because cash flow wasn't being generated at $100, that cash flow, they would be in really, really big trouble at $60. And OPEC thought that. But if you're running a business and you are the prices are so good, you can't imagine that they're this good. You're going to plow everything back into that business, and that's basically what they were doing. And I saw ConocoPhillips when I worked for them; they would do that. When times were good, they would plow everything back into the business because prices are high. We've got to strike now. We've got to take advantage. And then when prices would fall, they'd slash spending, and they'd actually be able to turn a profit at lower prices. And it's just because they're plowing everything back into the company at those high prices to take advantage and get as much market share as they can.
That's interesting. There's also risk with that strategy too. I guess that's what leads to the boom and the bust in this cyclical nature of oil. I want to ask you now about the natural gas market. The U.S. is transitioning to LNG exporters. Cheniere Energies should be bringing on their LNG export facilities in the near future. But we've had the LNG price fall. It's obviously the LNG price is not the same price in every single market overseas. The natural gas market is more of local markets. But do you think this is a miscalculation now that all this capex, these billions of dollars have been raised for LNG export facilities and the natural gas, the LNG price in so many markets has fallen? Do you think these guys are still going to be able to make money consistently long term?
Yeah, I think if they had a crystal ball 10 years ago, a lot of them wouldn't be investing the money in the LNG export terminals. It's going to be difficult to compete with some of these mega projects in Australia. They really need oil prices to be higher to make this really lucrative. Now, the natural gas price in the U.S. it's the right price. But it's also a function. It's a function of gas prices locally and the oil markets, because LNG competes with oil in a lot of places, and it competes with coal in a lot of places. So it's a function of global energy prices, and it's a function of the local gas prices. And those conditions right now, on the gas side they look pretty good, but on the commodity prices, globally they don't look very good. So I think Cheniere is probably starting to make a little money finally after all these years of investing money in the projects. You got a few other guys coming online. I did my latest for Forbes. I did write an article on that, and the amount of capacity that's pretty far along. And if you add up all the capacity for LNG export terminals, for chemical manufacturing, for utility switching, I mean, it's a lot of gas. It's something like, probably another 50% on top of the gas consumption or the gas production that we have now. So, to the extent that Marcellus can keep expanding production, it can maybe keep prices in check. But should it stumble or should production start to decline, we're going to see much higher natural gas prices in the U.S. So I'm sort of natural gas in the short term is always a bet on the weather. And so in the short term, I look at the price and I go, well, we have very, very high natural gas inventories going into the winter. If we have a super cold winter, then yes, we'll see gas prices spike up this winter. If we don't, we could see the bottom fall out again in the spring for natural gas. But longer term, it looks pretty bullish for natural gas. In fact, I recently bought EQT, which is a natural gas producer in the Marcellus. I think long-term picture for them and for some of the other producers there looks pretty good.
Yeah, a lot of power plants in the U.S. Have actually switched over from coal-fired to natural gas because it was cheaper. And obviously, besides just being cheaper, it's also better for the environment because it's less carbon emissions. So I think the U.S. now has had its lowest carbon emissions in 30 or 40 years, and a lot of it's because of economics, because of the cheap, abundant natural gas the U.S. has for right now.
That's correct. I mean, a lot of environmentalists will point to renewables, and I will say, look, the vast majority of this is just from natural gas switching to coal. I mean, you can do the numbers, and you can see that, coal is not being replaced in vast amounts by renewables. Coal is being replaced. If you look at the curves, the coal has fallen off just about as much as natural gas has come up. And then you have renewables down there. In fact, we are adding the most renewable capacity, but capacity is not production. Those capacity factors for renewables are a lot lower. So the actual contribution of natural gas to reducing carbon dioxide emissions is far, far greater at this point than renewables.
Okay, I want to transition now to income investing in oil and energy. Many of our listeners are out there, they're looking for more income. I want to ask you about ExxonMobil, Shell, Chevron, those companies. With low oil and natural gas prices, are they hedged? Are they going to be able to generate enough free cash flow to continue to pay out dividends, or are they looking at dividend cuts if the oil price doesn't start going back up?
I think Exxon is fine on their dividend. They're always going to, not run up as high as the high guys and as down as low as, in the low markets. They've got a lot of, one thing, they've got a lot of refining assets, and those are going to be a drag. As oil prices go up, the refiners are going to get hit. We recommended rolling out of refiners, about a year ago now, and that was the right move because refiners have vastly underperformed. You don't want to be in a refiner when oil prices are going up in general because their margins get eroded. And ExxonMobil, all the integrated oil companies, they have refining assets. And so those are a drag. Even as their oil production and their gas production will make them money as those prices go up, you'll see refining to be a drag. For just income investors, I'd really consider the midstreams. The pipeline companies are really they got higher yields than most of the integrateds. And they're pretty undervalued right now across the midstream sector, and their tax advantaged income. I mean, those most of the income that you get returned back is depreciated and a return of capital invested, and so you get really favorable tax treatment on those for the master limited partnerships. If you're investing in a pipeline company, it's not a master limited partnership. It's not the case. But, those that are, you get like Enterprise Products and Magellan Midstream and companies like that. Those have very favorable tax treatment.
Yeah, I remember Kinder Morgan switched from an MLP back to a C corporation for tax purposes, and Warren Buffett was even buying oil stocks. When there was a dip, he was buying Kinder Morgan and Phillips 66. So Warren Buffett's known for having very poor success with oil and energy investments. I think his worst investment was ConocoPhillips, right? So I guess objectively, when you were looking at discounted cash flows, the oil industry, a lot of the more mature companies, they were just really stupid valuations earlier in the year.
Yeah, I agree. And you're right. Warren Buffett has had very poor timing on some of these. He's been accumulating Phillips 66, which I also own from my time working for ConocoPhillips. When they split, they gave us shares in Phillips 66 and shares in ConocoPhillips. So I've got shares there, so I watch it kind of closely. I felt like it was really richly valued, so I never recommend it to other people. But Buffett has accumulated a lot of shares. I mean, he owns, I don't know, last I checked, 15% of outstanding shares or something. And if people wonder why is he investing there, because those refineries are along his railroad, and so for him it's there's synergies there that the Bakken oil production gets shipped along his railroads to refineries, Phillips 66 refineries that he has a major ownership stake in.
Oh, that's very interesting. I didn't know that, but I'm not surprised. Warren knew ahead of time about the shale oil boom, and that's why he was buying those railroad stocks. People were questioning, well, what is he doing here buying these railroad stocks? And it's because he knew the shale oil boom was going to take off, and the railroad companies were going to move the oil out of the Bakken.
Yeah, and that's why he certainly does not want to see new pipelines built. I can tell you, he doesn't want to see new pipelines built out of the Bakken. He wants to keep that market cornered.
Yeah, Warren plays a lot of politics with his investments now. He's definitely gotten a lot more political over the years rather than just buying companies. He's gotten into the political process. I actually want to ask you about the political process right now. Donald Trump has said if he wins the election that he wants to open up government lands. He wants more oil and natural gas drilling. Is there a lot of potential there to increase production even further than if the government lands were to be leased out then for private oil companies to produce more oil and gas?
Yeah, I was actually on a radio show last night, Dave Pratt Network, and they asked me that question. They said, "What does a Trump presidency mean for oil and gas?" And I said, "Well, I think he will try to eliminate some of the regulations and try to open things up a little bit more. I don't think he can do much for coal because really yes, regulations have hurt coal, but mostly natural gas is what's hurt coal." But the main thing is just the price. And a president can't, if you look, and I always point this out ironically, in Bush's 8 years, oil production fell all 8 years he was in office. And in all 7 full years of Obama being in office, oil production went up. Why? Because that's when the shale boom happened. Now, Obama has not been a friend to the oil industry. He's certainly put a lot of regulations in place, and he's put restrictions on drilling. But that couldn't overcome, the shale revolution. The shale revolution happened mostly on private land. And, I think that'd be the same with the Trump administration. You might see incremental production be a little bit higher than it otherwise would have been. And I think that's with Obama. We may have seen incremental production be a little bit higher than it would have been. But, the oil markets are cyclical, and they definitely trump any presidency. No president is going to be able to have the power and authority to make huge swings one way or another. I always say, that just watching oil production during Bush and Obama should be enough to convince anyone that a president has fairly limited ability to impact the oil and gas markets.
Those are great points. And Obama upset his environmental base for allowing all this oil and natural gas fracking in the United States. But he took credit for how well the economy was doing when the shale boom was at its peak and, jobs were being created very rapidly in North Dakota, Texas, and Oklahoma because of the shale boom. But I don't think, I agree with you, and I don't think politicians should take that much credit for these things. A lot of it does have to do with the oil price. So if when the oil price was triple digits, when it was around $100 a barrel, there was going to be entrepreneurs out there like the book and the Frackers talks about, like George Mitchell and all those other guys, and Harold Hamm, who are going to figure out ways at $100 a barrel oil to create new oil production with the new technologies and techniques from horizontal drilling and hydraulic fracturing.
Yep.
Well, Robert, I really enjoy your insights into the oil and natural gas markets. I think you provide a lot of value for your subscribers. I've read your newsletter for a while. If our listeners want to find out more about your work, how do they do so?
So a couple of places. I've got a couple of weekly columns at Investing Daily. One is generally on the midstreams, on the master limited partnerships, and one is on the broader energy sector. And then I write a column, typically one a week for Forbes. Now, Investing Daily, we do have also a subscription column where we make specific buy-sell recommendations. And the second weekly is about to come out. And my colleague Igor Greenwald is writing that one, and he's writing about the Standing Rock Sioux and the pipeline protests up in North Dakota. And I think people who have an open mind will find it quite interesting, because I think people have been very, very misinformed on this issue.
That's interesting. Yeah, I hear the protesters are not being treated with good free speech laws, unfortunately, from the stuff I've seen posted on social media.
Well, you can't believe everything you read on social media. That's the point that we will make. A lot of the things, like I'll give you an example. Robert Reich, former labor secretary, has said, these protesters are these peaceful protesters are being attacked while occupying federal land. That's not true. That's not accurate. Or that the pipeline, many people think this pipeline is going across a reservation. It's not. Or former treaty land. It's not. So, a lot of misinformation. And Igor kind of just spells it out. He's got links. He's got, linking to court filings and to, he spells it out. And I think it's very easy to be sympathetic. I posted something yesterday about people, objectivity being a lost art. And I know a lot of my liberal friends pat themselves on the back and say, yep, those conservatives they do not know how to be objective. And I'm going to say, well, surprise. This is one where you, and Igor points that out. He said my liberal friends are all checking into Standing Rock without really knowing the first thing about the facts on the ground.
Okay, well, I'll put a link to that piece in there so our listeners can read it and judge for themselves. But I want to thank you for your time, and keep up the great work covering the oil and gas markets.
All right. Thanks for having me again.